So today we're going to talk about, here's our financial planning topic. So now we're going to divide the video. You're going to have the full length video to read from or watch. And then we also just had the financial planning topic. So if you're joining us just for this topic on YouTube, please remember to hit the subscribe, like, and notification button. But today we're going to follow I'm pretty sure this is the last of our investment fundamentals, and we're going to talk about stock, different types, and dividends. So there are three general types of stock. So stock is equity owned in a company, publicly traded company. Typically, yes, you can have stock in private companies, but we're talking about public common stock today. It's equity in a company. That's why it's referred to. You'll hear us talk about it as equities, and some of these investment folks often refer to them as equities. So I'll read you a definition again from Investopedia. You know, I like this website for you folks, but a common stock is a security that represents ownership in a corporation. If you have just one share of whatever stock you want to use, for example, then you have a piece of ownership in that company. Holders of common stock elect the board of directors and vote on corporate policies. The form of equity ownership typically yields higher rates of return long-term, this common stock form. If you own, so what they're saying is that other than some of these other types of shares, particularly preferred stock, if you have common stock, it typically has a better return or growth potential over time. You could, of course, lose every dollar you invest in any company in common stock. Even if that company doesn't necessarily go out of business, right? So GM went bankrupt during the Great Recession and common stockholders received zero, right? They lost all their money, even though you can still buy a GM car today. This form of equity ownership, okay. However, in the event of liquidation, this is a really good example. In the event of liquidation, common stock shareholders have rights to accompany assets only after bondholders, right? So GM bondholders got I think it was about 10 cents on the dollar. Preferred shareholders, we're going to talk about preferred shareholders or preferred stock, and other debt holders are paid in full. So bondholders, preferred stockholders, and other debt holders have to be paid before common stock holders are paid. So if you're an owner in the company, you're in basically last place. Common stock is reported in the stockholders' equity section of a company's balance sheet. Common stock is a security. So as a recap of common stock is a security that represents ownership in a corporation. In a liquidation, common stockholders receive whatever assets remain after creditors, bondholders, and preferred stockholders are paid. So important to know those differences. Now, we talked about preferred stock. So what is preferred stock? So let's check off common stock. So now what is preferred stock? Preferred stock is a type of equity, right? So same thing, you have equity in the company that represents ownership of the company and the right to claim income from the company's operations. You don't have that right in the common stock. You can be paid dividends, but you don't have that right. Preferred stockholders have a higher claim on distributions, dividends and such than common stockholders. Preferred stockholders usually have no or limited voting rights in corporate governance. Remember, the common stock, you elect the board of directors. Typically, it depends on the type of stock that you have. There can be different share classes that don't have voting rights and they're still common stock, but just generally. So, but preferred stockholders, we're talking about preferred stockholders here, they have no voting rights or limited voting rights in corporate governance. So it can be no or limited depending on how the chart is written. In the event of a liquidation, preferred stockholders' claim on assets is greater than that of common stockholders, but less than bondholders. So in the hierarchy, you've got company A, and company A liquidates. So the first people to get paid are bondholders. The second are preferred stockholders, preferred. And the last are common stockholders. So you could be a shareholder in a big company, and if that company goes bankrupt or just completely goes out of business, you're the third in line. So the reason that you typically have more growth potential here is because you're taking more risk. Theoretically, bonds have the least amount of risk. Preferreds are, it's tiered kind of the same way, least amount. With bonds, preferreds have, the next level of risk, and then common has the most. Preferred stock has characteristics of both bond and common stock, which enhances its appeal to certain investors. So obviously, these are not recommendations to buy any of these. It's just an overview of how different types of stock in a company work. Preferred stock typically do not share in the price appreciation or depreciation to the same degree as common stock. The inherent value of preferred stock is the ongoing cash proceeds investors receive. So they are valued a little bit differently. So common stock is really the future earnings of the company. That's what the value is based on. It can also be based on the dividends, but most of common stock value comes from what we think it's going to be worth 12 months, 3 years, 5 years from now. Preferred stock is really somewhat, because you don't have as much appreciation, but it's the collective value of the future income payments. All right. Now, what about restricted stock? Not a lot of people are involved in restricted. So we talked about preferred. Not a lot of people are involved in restricted stock, but some people are. So I thought it'd be worth mentioning it, because someone would probably put up a question. Well, what about restricted stock? And that's good. Restricted stock refers to unregistered shares of ownership in a corporation that are issued to corporate affiliates, such as executives and directors. Restricted stock is non-transferable. So if I'm a restricted stockholder, I can't sell it to somebody else. It must be traded in compliance with special SEC, Securities Exchange Commission regulations. The restrictions are intended to deter premature selling that might adversely affect the company. Restricted stock typically becomes available for sale under a graded vesting schedule. So a vesting schedule is you might receive this. You might receive 100,000 shares of ABC company, but you can't sell any of that until it vests, which means you might. So what I say, 1,000 shares, 100,000 shares, whatever I said. So a portion of it, let's say 25% of it becomes available to sell after year 1. And then 25% of it becomes available to sell after year 2, and so on. So that's a vesting schedule. Vesting schedules can be very different. Then they tend to last several years. Restricted stock is also referred to as letter stock and Section 1244 stock. All right, so that is restricted stock. Now let's talk about dividends. A lot of focus on dividends. I've talked a lot about dividends this year. Many of the things that we're implementing in strategies pay higher dividends because, while we have this risk of falling markets, I want positions to some degree in our portfolios that are gonna help pay higher dividends. So at least we're getting some return, right, and cash flow while we're waiting. So there are different types of dividends. So let's talk about, okay, we went through common stock, preferred stock, restricted stock. Now let's talk about dividends. Well, the first we're going to talk about is qualified dividends. So some people talk about qualified and non-qualified. It's actually qualified at ordinary. So let's talk about qualified dividends first. Each different one has a different tax implication. That's really what drives it. So I'm going to share with you and why these are so important. So I'm going to pull down my website. I'm going to tell you where you can grab this information. So again, here's where you would land. Go to attleborowealth.com. You land on the home page. Raise your hand for me if you can see my website. Thank you. Hey, Michael, good to see you. All right, then you go to Slot Corner. And as you scroll down, I'm going to take you to this very familiar 2022 tax planning. So I want you to focus on right now this block up here. Taxable income brackets for 2022 long-term capital gains and qualified dividends tax. So you'll see here that if you're married filing jointly, you can pay 0% on dividends or capital gains. And that's all the way up to a modified adjusted gross income of $83,350. And then, of course, 15% is where most people pay capital gains or dividend rates. And that goes from $83,351, of course, to $517,000. Now, once you cross over $200,000 for a single filer, I'm right here, or $250,000 for a joint filer, we have to add on the 3.8% Medicare surtax that came from Obamacare or the Affordable Care Act. So that added on an additional tax on the dividends for anybody making more than $250,000 as a joint filer, or $200,000 of modified adjusted gross income. So this could be 18.8 and this could be 23.8, but still less than the ordinary income rates that we see over here, right? The ordinary income rates or marginal tax rates on the left here. For that same 83,000, if you're paying, even if you're at 18.8, that's still less than the 22% marginal rate here. And of course, if you're at 517, you're all the way up in the 32 and then into the 35% bracket. So you can see where qualified dividends can be better for you from a tax point of view. So the big difference and why you got to pay attention to the type of dividends that you have are, of course, the taxation of those dividends. And of course, capital gains, but we're not talking about capital gains today. So let's see, qualified dividends are listed in box 1B on IRS form 1099 DIV, 1099 DIV. And that's a tax form, of course, sent to anybody who gets distributions. Now, sometimes you can't control these. We certainly can't control dividends in a mutual fund. And I guess you could control them in a common stock if you bought them, if you sold your position prior to what's called the ex-dividend date. But capital gains, can cause a lot of problems if you're not expecting it, not planning for it. So let's move this back up here, out of our way. To qualify for the qualified dividends of 0, 15, or 20 plus the potential surcharge, they must meet certain requirements as outlined by the IRS. So the dividend must have been paid by a U.S. company or a qualifying foreign company. The dividends are not listed with the IRS as those that do not qualify. So there's a listing, and the required dividend holding period must be met. So dividends that do not qualify right off the bat, we know are anything that comes out of REITs or real estate investment trusts. So they tend to pay some higher dividends at some time. So you've got to adjust that value based on it paying ordinary income. So what happens when I may not have explained this clearly, but what happens if you don't qualify for those preferred rates, right? The 0, 15, 20 plus the surtax. What happens is those dividends flow right into your marginal tax brackets. Remember our graduated cylinder, and you've got those, 10, 12, 22, 24, 32, 35, and 37. These are your marginal tax rates. So any dividend that you have, again, if you get $10,000 in qualified dividends, it follows that smaller schedule, 0, 15, 20 plus 3.8 potential surcharge. But if so these are for qualified dividends. These are for ordinary dividends. So obviously this is better from a tax point of view, that the money that, your dividends fall into here because you're likely to pay lower tax. If they fall into here, depending on where you land, you could certainly pay higher amounts on tax on those same dividends. So it's important to know whether your dividends are qualified or ordinary. Master limited partnerships don't qualify. Those on employee stock options, dividends paid from money market accounts don't qualify. Deposit and savings banks, credit unions, or other financial institutions do not qualify and should be reported as interest. Special one-time dividends also are unqualified. Lastly, qualified dividends must come from shares that are not associated with hedging, such as those used for short sales, puts, and call options. And I explained that if they're not qualified, basically they're subject to ordinary income tax. They're ordinary dividends. The holding period that's referred to gets a little complicated. So I'll just read. It's not too bad. I'll read this to you. The IRS requires investors to hold shares for a minimum, so this is common stock holding, for a minimum period time to benefit from the lower tax rate on qualified dividends. Common stock investors must hold the shares for more than 60 days during the 121-day period that starts 60 days before the ex-dividend date. So the ex-dividend date is when the the company declares the dividend date, and then it's a scheduled period of time before that, or the date after the dividend has been paid out and after which any new buyers would then be eligible to receive future dividends. For preferred stock, the holding period is more than 90 days during a 181-day period that starts 90 days before the ex-dividend date. So different rules for common stock and preferred stock. And I have to tell you, I knew this going into my licensing and other requirements, probably my CFP exam too. I had to look this up. I can't remember these holding periods. So I don't expect you to. I'm just giving them to you as a reference. For mutual funds, it's different. The holding period requirement are somewhat different. In this case, a mutual fund must have been held unhedged for at least 61 days out of the 121-day period, which began at least 60 days before the ex-dividend date of the security. Investors must have held the applicable share of the mutual fund for the same period as well. So the holding period can be challenging. If you're counting on the dividends, just make sure that you're holding the period or holding the position so that you qualify and can receive those dividends. And then you're going to want to know whether they are qualified or ordinary, so you know when they're going to be taxed or how they're going to be taxed. So your next question may be, well, how do I know? Well, you have to really check with your custodian. So we pull up we custody with now TD Ameritrade and Schwab. We're completely done with Fidelity now. So it's TD Ameritrade and Schwab, and we check the positions. Of course, any of the ones I told you that are not qualified, REITs, real estate investment trust, master limited partnerships, also business development companies. They don't qualify. They're ordinary dividends. So you wouldn't necessarily know without asking your advisor or going direct to the custodian. Okay, well, we talked about a lot today. We had some good headline updates. We went over some timely information from the Slack group. We talked about Social Security a bit and the markets, and then we talked about, during our financial planning topic, different types of stocks and dividends. So there is a question. Let's just see. So Keith asks, I thought you had to hold a stock for 1 year before dividends are qualified. You're thinking about capital gains, Keith. You have to hold, typically, you have to hold a stock for at least 1 year before your any gains you have qualify as long-term capital gains, which again, long-term capital gains, if they're qualified, fall into the same category, this smaller scale, 0, 15, and 20, plus the 3.8 Obamacare surcharge or Affordable Care Act surcharge. So that is capital gains greater than 1 year. If not, they fall right into your ordinary income and are treated as ordinary income. And they fall right into your marginal tax bracket wherever you happen to land. Good question. Of course, you're welcome. All right, everybody, we will not see you next week. There is no webinar next week. We will see you on the week of the 25th. So we're going to have the weekly webinar on the 25th, and then we're going to have Heather Schreiber on the 26th at 6:30. So I hope you can join us for both. Have a great week, and give us a call with any questions. Take care.